Hey everybody, and welcome to Side Hustle Ideas. I am Bill, the company's expert, and I just want to tell you that you can do it too. There's never been a better time to earn extra money by having your own business, either as a side hustle or as a full-blown entrepreneurial venture. There has never been an easier time, better time, because of all the amazing resources that we have access to these days, a lot of which are on the internet. So welcome to Side Hustle Ideas. And before we get into it, I just want to say that starting next week, I will no longer be doing these live streams on this channel, at least for a little while, certainly, possibly, or probably for longer. But they will be going over to my other channel, the company's expert 2. So right there, if you can see, find my finger here, right there, the company's expert 2. Go and subscribe to that channel so that you can see these going forward. So today I thought that we'll do something that we haven't done before, which is take a little dive into the basics of financials, right? This is something that a lot of people talk about. I resist talking about it usually, but I think it's important to talk about it here to avoid some of the startup mistakes that a lot of would-be small business owners and startup founders fall into, which is not understanding money, basically, and your attitude towards money and how it should work when you're starting a business. Okay, and in order to do this, I wanted to use as example some high-profile companies. These are not startups by any means. They're the polar opposite to startups, but they're examples that hopefully everybody's familiar with. One is Disney, and the other one is Coca-Cola, okay, for want of a starting point. Something that hopefully everybody can relate to in the sense that you might have heard of these companies. So let's do that. Let's see if I can get my screen working here. Here we go. So what I've done is I've pulled up, this is Wikipedia, okay, as I'm sure many people will recognize. And this is Disney, okay, and it has some of the financials here, just a very glossy sort of overview. And same thing for the Coca-Cola company, okay, so they own Coca-Cola and a bunch of other drinks and products and things like this, okay. But once again, they've got their financials there, or at least, you know, a very simple overview of their financials, just the basics, right? So let's contrast these companies. Now, I'm going to break this down for people that that don't really know this stuff, don't really talk about financials of business and things very often, and it will be hopefully a learning experience for everybody. There are 12 of you guys here. Thank you for being here, and this is still a Q&A, so get in the chat and ask me some questions. In the meantime, let's do this. Okay, so here's the deal. Hopefully everybody has heard of revenue. Okay, revenue is the amount of money that comes in the door. If this was a store, it would be the amount of money in the cash registers, right? The total amount of money. It's also called the top line, right? Because that's the amount of money you start with. Obviously, you don't keep all the money in the cash registers. Okay, that's just the amount of money you have to work with that comes in the door. Okay, so in the case of, this is Disney. Okay, in the case of Disney, you've got 82 billion. So in 1 year, their revenue was 82 billion. In 2022, 82 billion. Okay, that's how much money came through the door. Now, Coca-Cola, let's look at Coca-Cola, or the Coca-Cola company. Their revenue was 43 billion. So roughly half the size of the Disney company. Okay. Incidentally, Disney, according to Wikipedia, employs in the neighborhood of 220,000 employees, and Coca-Cola employs in the neighborhood of 86,000 employees. Okay, so Disney has more than double the amount of employees that that Coca-Cola has, and double the revenue. Now, contrary to popular belief, it's actually not that hard to make revenue. Okay, you could make I could make $5 revenue right now. Okay, I could just sell my computer and live streaming video making setup here for $5, right? So in my first 5 minutes of running this, whatever this is, I've made $5, right? Now, the computer setup here cost me probably over $1,000, but I could sell it for $5. I could offer it for sale, and someone would probably buy it if it's worth like $1,000, and I sell it for $5. But I could then brag and say, look, in my first 5 minutes of being open for business, I've made $5 revenue. Right? So you see, it's not that hard because you don't disclose what you're doing to make that revenue. Right? And in financial statements, and I know this isn't a financial statement, but in sort of statements like this, they're not saying, what they've done to make this 43 billion, right? Or in Disney's case, 82 billion. But hopefully everybody understands revenue, okay? The next thing that they've listed on here is operating income, okay? So the thing that I find really stupid and annoying about accounting is that they can never even define their terms. They're always using different words to describe the same thing. It makes what they do seem a lot more complicated than it actually is. That's the big thing about accounting. But another term for operating income here is EBITDA. Okay, you might have heard that, EBITDA. It's if you want to sound really smart in the presence of business type friends, just start talking about EBITDA. Okay, it's EBITDA. Okay, so EBITDA, and it stands for earnings before interest, taxes, depreciation, and amortization. It's kind of a term that people throw around. I don't believe it's an actual official accounting term, or it's officially recognized. But yeah, you can talk about EBITDA. Limaz is here. Limaz says, "Hi, Bill." Hi, Limaz. Okay, so another name for EBITDA is operating income, and all this is it's your revenue minus the immediate costs of making that revenue. So let's pretend that you had a factory, okay? Something that you can visualize. You have a factory, and let's say it makes cars. And that factory, in order to start spitting out cars, it's going to have some expenses. It's going to have costs. Like, for example, labor. You got to pay the salaries of the people that work there. Utilities. You got to pay for electricity and gas to, power your factory. You have to pay for maintenance and repair of the equipment in the factory. And keeping everything clean and all that kind of stuff. And, last but not least, you got to pay for raw materials. So in one end of the factory, you've got steel and rubber and plastic going in, and the other end of the factory, you got cars coming out. So the inputs, the raw materials, steel, rubber, plastic, glass, whatever they use, that costs money, right? So you're going to add up these expenses, materials, labor costs, energy costs like utilities, maintenance and repair costs, et cetera, and you're going to deduct those from your revenue, okay? You've got a certain amount of revenue selling the cars. That's what the customers give you. You're going to need a huge chunk of that to pay your bills, okay? So going back over to this, in the case of Disney, so they have a revenue of 82 billion. Their operating income, once you subtract the costs of making that 82 billion, the day-to-day costs, okay, labor and salaries and all that, you're left with 12 billion. Okay? So you went from 82 billion to 12 billion. So your expenses to run the business, called costs of goods sold, are roughly what? 70 billion. So 82 minus 70 is 12. So you're left with 12. Okay? Now, this shows you the effectiveness of your operation. Okay, in our example, it was a factory, right? So our factory, let's say we had these numbers. Let's say our factory produced a revenue of 82 billion, and it had 70 billion in operating expenses in order to run the factory, and we're left with 12 billion, and this would be your profit if it weren't for certain other things. Okay, so now you play a game of deducting other additional weird costs, right? These are We've subtracted the costs for real things, salaries, energy, materials. You can visualize what those are. Those are real, tangible things that we need to run our factory. But now we have a bunch of other costs, but they're intangible things. They're financial things. Okay. So coming back to the other name of this, operating income, it was called EBITDA, earnings before interest, taxes, depreciation, and amortization. Interest and taxes, hopefully everybody knows what those are. You borrow money from the bank, you got to pay interest on it. So interest that you got to pay back to the bank, that's a cost, right? But it's a weird financial cost. It's intangible. You're not actually buying anything with that money. Taxes, hopefully we all know what those are, right? It's something you pay to the government, right? By law, in order to the privilege of doing business, they require that you pay them some of your profit or your income. So, and then depreciation and amortization, those are weird accounting things. We'll maybe get into what those are later. It's just more of an accounting kind of thing. So if you own this factory, okay, if you owned a factory and it was yours outright and you just paid cash for everything, you'd be done. Okay. You brought in $82 billion revenue. You had $70 billion worth of expenses and you're left with $12 billion left over. That's what you can put in your pocket. That's your operating income. If you didn't borrow any money or you didn't have to pay taxes, you'd be done. Your profit would be $12 billion. And there you go. However, that's not where we end. Okay. Because in the real world, there's other things you got to do too. So in the case of Disney, which is where these numbers come from, you've got to remove other things. So you remove, you don't get to keep the entire $12 billion. You got to pay some of it in taxes. Okay. So there's a cost. You got to pay some of it in interest to the bank because you borrowed some of your money and you've got to pay interest on that money, right? So some of your net income goes, or your operating income goes to pay the bank. Then you've got other accounting expenses and you're left with, in Disney's case, $3 billion net income. Okay. So, net income is supposed to be profits. It's, you've gone from 82 billion all the way down to 3 billion. Okay, now I don't know what kind of margin that is. That's not a very good margin. Let's look at Coca-Cola. Coca-Cola, they started with 43 billion and they had, like, I guess 33 billion or so in operating expenses, which left them with 9 billion. Okay, now, so what a difference here. You've got Disney, which is much bigger. They're bringing in twice the amount of revenue, yet they end up with 3 billion. Coca-Cola brings in half the revenue, but ends up with 9 billion. Okay, so Coca-Cola is looking like the winner here. To put it another way, Disney is employing 220,000 employees to make $3 billion. Coca-Cola is only employing 86,000 employees, like half or a third, okay, to make 9 billion, 3 times the amount of money. Okay, so this is how these two companies stack up against each other. Now, net income. Okay, let's do a thing here where you go net income. I want to show you something. Okay. So net income. Now you might be wondering, like, can we tell if these companies are profitable? Net income is profit. I don't know how you would write that as a type of question. So typically net income is synonymous with profit since it represents a company's final measure of profitability. Okay. That's supposed to be what it is. Now, so here's the thing though. Which of these two companies looks like the best investment? Just out of curiosity. Well, Coca-Cola does, because Coca-Cola is making 3 times the net income. But you can see how all these other numbers are deceptive, because even though Disney is more than double the amount of people, more than double the amount of money coming in. They're not doing a very good job compared to Coca-Cola of running things. Youssef says, "Good morning, teacher." Good morning, Youssef. I'm glad to see you here. Just a reminder to everyone, like I was saying this morning, make sure that you're subscribed to my other channel, because starting next week, whenever I do a live stream, it's going to go on to my second channel, The Company's Expert 2, and not this channel. So these are moving over to my second channel. So make sure that you go there and that you're subscribed. Okay, so what's the lessons we can derive from this? Okay, first of all, I guess we could talk about Disney and Coca-Cola, and then we can talk about the greater lessons for entrepreneurs and startup founders and people who want to do side hustles, and what your attitude should be towards money. Okay, first of all, let's talk about Disney versus Coca-Cola. Okay, so as you can see, Disney is doing a much poorer job compared with, say, Coca-Cola. Now, this illustrates how you can be big, okay? There are many different measures of the size of a company. One measure is the amount of employees, okay? In that respect, Disney is bigger than Coca-Cola. There's another measure of the size of a company is the amount of revenue you bring in. Once again, Disney is much bigger than Coca-Cola, okay? However, one could argue the real measure of how big, quote unquote, a company is how profitable it is. In this case, Coca-Cola is the clear winner, because you can be smaller, you can have less people, you can bring in less money, but you can make more of a profit just by operating differently. Now, granted, these two companies are not in the same industry, and different industries have different norms, okay? What we're doing by looking at this stuff, like if you say, Disney, for example, made $3 billion net income, which is profit essentially, $3 billion on a revenue of $82 billion, okay, versus Coca-Cola making $9 billion on a revenue of $43 billion. This type of thing is called ratio analysis. We're looking at the ratios between these key financial numbers, okay? That's called ratio analysis. This is what a lot of investors do to determine things about the company. And while it isn't the entire picture of what's going on, it gives you a lot of insight into some of the things that are happening behind the scenes. Okay? So for example, one of the basic things you could conclude here is that Coca-Cola is a lot more efficient than Disney. Okay? They're making less money, but they're keeping more of it. Okay? Whereas Disney, they're bringing in a lot more money, but they're spending way more of it. Okay, so you're only left with a tiny little piece at the end. Now, the other thing, incidentally, that you have to talk about, that not a lot of people talk about in terms of investment, is remember, at the end of the day, you have the option of, if you were an investor, you could take your money and you could park it in a savings account in the bank. You could not invest in a company. You could just put it in a savings account, right? Savings accounts make a certain amount of interest, right? So you're also comparing the performance of these companies to what your local savings account would, okay? So at the very low end, savings account make, I don't know, like 1, 2, 3, 4%, somewhere in there, right? Now look at Disney, okay, $84 billion to make $3 billion. They've employed 220,000 people. They own $203 billion worth of stuff, okay, in order to make $3 billion profit. Okay, so is it a good investment to invest in a company that owns $203 billion worth of stuff? This is like their theme parks, their, I don't know, movie studios, like all the stuff they own, okay, and they employ all these people just to make $3 billion. Whereas Coca-Cola, they own less than half of that stuff. They own $92 billion, okay? They make less than half the amount of money coming in the door, but they make 3 times the amount of profit that Disney does, okay? Now, what's the ratio here? 9 billion on 43 billion, that's what? Approximately 20%? 20% profit? That's more than taking your money and parking into a savings account, usually. Okay? Walt Disney Company, let's see. They've got 3 billion on top of 82 billion. So that's what? I don't know, 5%? 5%? This here, it's like you're kind of on par. It's even money whether you should invest in Disney or you should just take your money and park it in your bank account, right? So that's what this is revealing to us. So that's what I'll say about these two companies. I mean, you can obviously go on, and I mean, I don't do this stuff for a living. I mean, I have a master's degree in finance, but I don't do stocks and stuff. It just, I said all of this to say the next part, which is, what does this mean to people wanting to start a company and run a company, even on a very small scale, if it's a side hustle? Okay. What does this mean? Well, as you can see here, the first takeaway, okay, is that in the case of Disney, they lost a lot of money, okay, because when they went from here to here, when they went from operating income to net income, so their businesses were bringing in 12 billion a year. Okay, so that's like profits from movies and theme park ticket sales and all this. Their businesses were operating profitably, so they're making some money, but they lost most of it. They went from 12 billion down to 3 billion due to financial expenses. Okay, so interest payments, taxes, things like that. Okay, so their financial costs were wiping them out here, more or less. Coca-Cola, look at the difference here. Their operating income was 10 billion. Okay, so their businesses brought in 43 billion, but they're keeping 10. So their businesses are profitable. Okay, selling like what do they do? They make drinks. They make they make the syrup, I think, right? They don't bottle the drinks, I don't think, anymore, but they make the syrup and send it to bottling companies or something. So they brought in 10 billion, but of that 10 billion, they're keeping 9. Okay, so they had very small financial costs. So the amount of money they paid in interest and tax is very small. Now, a lot of these organizations, they have some very smart people working there, and they have the capability of avoiding a lot of taxes. They operate all around the world, and they know all the loopholes and take advantage of all the government tax breaks. So they make it. It's not really taxes that this is disappearing to. This is disappearing to interest, most of it. Okay, so they're borrowing a lot of money and they're paying lots of interest payments in the case of Disney. So it's gone from 12 down to 3. So their interest payments are wiping them out. They could be as profitable as Coca-Cola if they weren't paying a lot of that money, 3/4 of their profit, to the bank. Okay? Coca-Cola, they're losing 10% of their money to financial costs, like interest. Okay? So that's the first kind of thing here. Now, how much money should a company borrow? It's very complicated. There's a lot of different factors involved. But at the end of the day, I personally am very old-fashioned about this. Okay? The reality is that if you're paying a ton of money out in interest payments, it does two things that are bad. Number one, it makes your business a lot less secure, because if sales go down for a little bit, the interest payments wipe you out, and you basically go into bankruptcy. Okay, if you're not careful. So that's the first thing. The second thing is that just eats your lunch. The banks eat your lunch. You take all the money that you could have put into your pocket and you pay it out to the banks in terms of interest, and that's that's continuously, every month, every quarter, you're paying that out to the banks. So basically, you're working for them. So not a good thing to do. And I've seen a lot of small business owners and startup founders. They go out and they borrow. They take out a lot of these business loans. And same thing, they have lots of cash in their checking account because of it. So they start spending money recklessly on things that don't really need to be spent on, and then you got to pay you got to pay the piper, and that wipes you out. You'd have been really profitable beforehand, but once again, you end up working, and the bank takes your profit. Basically, that's the end result. Okay. You can see that here with Disney. They could have been more profitable than Coca-Cola, and now they're making a third of the profit of Coca-Cola, all because they're paying the banks for money they borrowed. Okay. Now, the other thing about business in general is that you have control. You have direct control over the cost side. You do not have direct control over the revenue side. You have indirect control over the revenue side. You do stuff and you hope that it results in an increase in your sales volume. Doesn't always succeed. Sometimes it does, sometimes it doesn't. Okay? But the cost side, you can control that in a second. You could say, right, that's it. I no longer am going to pay for electricity for my factory. Bam. Right? There's consequences of that, but you can do it. You want to save money, you can save money instantly. You have direct control over the cost side. Okay? And as you can see here, these companies are run on some pretty tight margins. Okay? If you're making 82 billion, but you're only putting 3 billion in your pocket, if you decide to spend 3 billion on a new facility, right? A new movie studio or something like that, bam, there goes all your profitability. Now you're no longer making any money. You're doing this for fun. It's a hobby. Right? So the lesson here, which I'm not doing a very good job of conveying, is you have to be frugal. You have to really, really think about what absolutely needs to be, you need to spend money on, and then do that if there's no other way. Okay? If you threw money and spent money at anything that, somebody could apply some logic and say, well, it could pay off, right? You would never make a cent. You would never make any money. Okay, you got to be very frugal. And you can always tell the people that know what they're doing when they're starting a startup or a side hustle. You can always tell because they're very frugal. They don't spend money unless they have to. Okay, they spend money on things that are important, things that improve the quality of your product, okay, that make a direct material difference to how good the thing is that you're offering. But they don't spend any money whatsoever on anything that isn't essential. And that's a real lesson to take away. Youssef says, noted, many thanks for the update. Yes, I have like over 400,000 subscribers, but I don't have a lot of people turning up for these side hustles. I just ramble on and on. If I did them really, if I put a lot of time into them and spruced them up and thought everything out and did them almost like I did videos, then maybe that would change. But these are just stream of consciousness stuff and responding to questions. I like the responding to questions part. That's why I do them. Not that you would know that from today, but so far. But yes. So yeah. So that's why I'm going to focus more on videos and things. I'm going to scale back the live streaming. And I'm going to move it over to my other channel. I haven't done anything on my other channel recently. I used to put clip videos and a bunch of other things on there. I'm going to maybe start putting stuff on the other channel again, starting with the live streams. Yeah. So anyway, that's what I wanted to convey. Money is very important. If I can get my buttons right here. Money is very important in starting a business. You cannot make all your business decisions by looking at the financials. You just can't. And something I explained in my $100 MBA course, which is basically you're learning the same material as you would in an MBA program, except that it's self-study. What I was explaining in one of the videos is that all these different subjects in the world of business, like finance is one of them, accounting is another, marketing is another, operations is another, human resources, and innovation. Like there's many different subjects. They're all different ways of looking at the same thing. Okay, they're all different perspectives on business. And it's very hard to know which perspective is right when you make decisions about a business operation. Should you be wearing your marketing hat and make the decision from that angle, or should you be wearing your accounting hat and make the decision from that angle? Obviously, it's going to be a composite of everything, okay? But what I've noticed in my career is that people that come from certain disciplines and that's all they know, like an accountant that just knows accounting, or a sales manager that just knows sales and that's it, they tend to not make very good business leaders because they know that one perspective very well, but you really need a respect and understanding of all the different perspectives in order to really understand what to do, in my opinion. But this is the accounting angle that we very rarely talk about. So I just wanted to do that today. Anyway, unless there's any questions, that's pretty much all I have for side hustle ideas today. Remember that there are other options for you than just working as an employee your whole life. You can make money directly by yourself without going through an employer or needing someone's permission. You don't need a gatekeeper to stand between you and making money. Okay, that's what an employer does. And occasionally they decide to lay off employees, and they decide to transfer employees, and they decide to put you under a bad boss. Things like this, so you have no control. Well, just so you know, you don't have to live like that. If you live like that now, that's okay. But just so you are aware that there are other options in life, you can make money directly. The secret to knowing how to do that is to learn business. Business is the scientific study of how to make money through commerce. And it's a skill like any other. It's like a discipline like any other. And it's really not that hard. It's like learning mathematics or learning history. You can do it on your own. I created a course that you could buy, and that will definitely get you in there. But there's other things too. And, if this is something you would like to do at some point in your life and eventually end up working for yourself, it's great. The other advantage, of course, is that there's no ceiling. There's no cap on the amount of money you can make. So if you do a really good job, you have a few great ideas, and then you're also very good at the execution, you get to keep the money. That's the thing. You don't have to share it out with anyone else if you don't want to. Okay? You can do it entirely on your own terms. That's the wonderful thing about it. So what I'd encourage a lot of young people to do is you should work at a day job. You should work see what that life is all about. If you have no experience there, it's hard to really get some perspective. But don't stay there your whole life. Stay there like a maximum of 10 years. I would say, if this appeals to you. And then whatever it is, whatever creative thing that, you might have, creative ideas you might have, you can do if you combine it with knowledge of business. Business is how to make money. So you might have a hobby, or you might have a passion. Okay, that's great. That's kind of the kernel of what you need. You might have a kind of rebellious attitude towards society or towards a certain aspect of society, and say no, this is stupid that things are done like this. Well, that's great. That's the kernel of, being able to do something. With a bit of business knowledge, you can learn to make money using your hobby or your passion or your idea. Okay, so it's a great thing. Youssef says, right now I'm an account, and I'm still learning I was an accountant in France. We were using IFRS. However, here, another system, GAAP. So there is no big difference, but some different. Well, I know GAAP. I used to get into this stuff years and years ago. GAAP is generally accepted accounting principles, right? So it's the standard, I believe, in the United States for, or maybe it's international, I'm not sure, for the rules on how they do accounting and how it must be done, or they revoke your license or something. Yeah. So, okay, well, if you know that stuff, Youssef, then I'm sure everything I did today is complete child's play to you. So, yeah, that's the world of accounting. No, I find that, I don't know, I just have a thing with accountants. Accountants, what they do is important, and what they do is certainly valid. But what I don't like is this sort of grandiose attitude that a lot of them have. And I mean in the business world, where, like, you know, who are we going to get to run the company? Let's get an accountant. I mean, just so you can understand some personal history, I mean, one of the first companies I worked for when I was starting off early in my career was General Motors. And General Motors, GM, they really screwed up over many years. Like, they used to be awesome decades and decades ago. They did quite a few things right back then, but sort of ever since, they've been sliding and sliding and sliding and sliding. And then it came to a head in 2008 with the Great Recession, where the CEO of General Motors, in that case, I've talked about this before, everybody knows, where the three CEOs of the three big American automotive companies, GM, Ford, and Chrysler, they took their private jets to Washington, D.C. to appear before the Senate committee or whatever it was, to ask for a bailout, to basically say, sorry, we have no more money. We need you to bail us out. Give, all that tax money that you collect from the American population. Give some of it to us to bail us out, because we have managed to practically bankrupt our company. We have no more money left. And if we go down, we will have to lay off all these people, right? So they flew in their private jets to Washington, D.C. to say, we're broke, we have no more money. Give us money, please, like a beggar with the little rattling the little can there. Now, who was the CEO of General Motors that did that? It was a guy, I think, called Rick Wagoner, and he was an accountant. So he was an accountant, which in my book is bad, because, talk about not displaying innovative thought. All they, in my experience, a certain type of accountant, all they do is they think of cutting costs. Yeah, you cut costs, but you also cut quality, because you don't know what you're doing. You're not an operations manager. You're an accountant. So all you can do is cut costs. You don't really know how to cut costs and boost efficiency at the same time and retain quality or improve quality. And you don't even understand the concept of quality. What is quality? What should we be doing that counts as quality? So it was a cluster whoops, basically. They drove the company into the ground. And this individual that was sort of the presiding king over the company for several years, they were two things that I think are bad. Number one, an accountant running the show. And number two, there's somebody who had spent their entire career inside that company. They'd never been outside of the company. They'd never seen other ways of doing things and experienced other cultures, other corporate cultures, like, other ways of doing things with different ideas. And so you get this distorted perspective that the way we're doing things is the only way those things can be done. And there are no other ways of doing it, right? So bad choice for who to run the company. So what do you think they did? Well, they didn't change anything. They kept everything exactly the same for many, many years while trying to cut costs, and that drove the company right into the ground. They went bankrupt and they had to be bailed out. So this is the problem with that type of thinking. And I worry right now, or I don't really worry, but I kind of wonder because Amazon is kind of in the same boat right now. After all the original creative people leave, the people that founded the company, unfortunately you get to a stage where the accountants take over and all they want to do is cut costs, and that's what they do. The problem is the quality goes down too, and that's what's happening with Amazon. Apple is kind of the same way too. Steve Jobs is no longer there. You get lesser people in charge, and they just want to do the same thing but cut costs. So, there you go. Anyway, that was a rambling trip to nowhere. Anyway, hopefully everybody understands when it comes to the financials and you're starting your own business operation, either as a side hustle or a standalone thing, remember, frugal is good. Only spend money if there's absolutely no other way, and it will have a direct result on the quality of your offering. Hopefully that makes sense. Thank you very much. You guys have been awesome. I wish you nothing but the best. I will be back shortly with my How to Get Hired live stream. Hope you can join me then. Take care.